FunSupermart.com.
How have Asia Pacific REITs performed in 2012 thus far, and what were the reasons for this?
The REITs market has performed very well. Our fund has gone up something like about 26% just for 2012 alone. And I think there are multiple reasons why it's done well, but I just want to basically focus on three main reasons. Number one, if you look at most of the high beta regional markets, risk appetite has returned. And so people are looking for capital appreciation. But in times like this, people want both a combination of risk control and also capital appreciation, basically dividends. And I think the REITs market fall into this because people are demanding yields, you see, and also capital uplift. And I think the third reason, which would be one of the main key reasons, would be also there will be yield compression. Interest rates will be very, very low for the next 2 years or even perhaps 3 years. And whenever there's any yield compression, REITs act something like a quasi bond market. When REITs compress, capital appreciation occurs, you see. So for these three reasons, I think they suit the REITs category pretty well, and hence that's why the performance.
Going forward, what are the key drivers of Asia Pacific REITs?
The key drivers would be yield compression, growth stemming from China, asset enhancement initiatives, market share control, and defensiveness and stability in markets such as Japan and Australia. For yield compression, we see that in Singapore, simply because of its above average yields. For Thailand, because Tesco, which recently listed one of its REITs there, has the largest market share control. And for Hong Kong, it's a function of tight supply and the growth story from China.
And what about the key risks?
There will always be risks. You're talking about equities, okay? Although REITs are, I would say, somewhere between full-blown equity and fixed income. There will always be risks. And the key risk, I guess, would be a global slowdown. I mean, if there's a global slowdown, then REITs will outperform relatively. But if it's a global bad slowdown, all bets are off. Or even worse, if you've got a global financial crisis from whichever fiscal cliff or from Europe that can't get their policies right, and some political mistakes, then I think every asset class will be hit as well. But that's not our base case scenario. Our base case scenario is that we believe that economic growth has troughed. You just look at China, the numbers for September are pretty encouraging, and even some of the macro numbers coming from US are pretty decent. So we believe that there will be growth, although it's subpar, and our, I don't know whether to say assumption or hope, for Europe it will be stability and a slow and tedious and long recovery. But at least you'll have China and US to back you up.
Considering all that you've mentioned before, what is your outlook for Asia Pacific REITs?
Sure, maybe I'll start with the sector we're most positive on, which is the regional consumer non-discretionary retail segment. We like that simply because it's less cyclical. In Australia, we like REITs with tenants such as Coles and Woolworths, the supermarkets. They may be like the anchor tenants, so supporting 50% of net property income. In Australia, we also like the office space, and that is mainly for markets where there's a tight demand and supply dynamic. For Singapore, we like hospitality simply because the visitor numbers are growing every year to new highs. We also like the office sector in Japan, in that we think that vacancy rates are bottoming, so therefore landlords with office space will be able to command a better rental rate going forward.
I think to elaborate also, you've got to realize, if you travel widely, not to say that we travel widely, but if you travel widely, you look at Tokyo, you look at Korea, everybody lives in apartments during the weekdays, because to get to work, it's good transport, but it takes a long time. Okay, so they have their bigger weekend homes family homes, and most of them they will either have to rent, and they will rent. Okay, this is too expensive, and so you've got a winning combination as far as Japan is concerned. And the REIT that she bought in, it's basically the bulk of it, almost 100%, is within 5 to 10 minutes walk from the nearest train or MRT station. For Australia, I just want to elaborate a little bit. Australia has done this very well, especially the last 18 months or so, because for one thing is that interest rate was easing, and because interest rate easing, you've got capital appreciation, and because the discount at NT is so high, so large, in any equity market, if the discount is too large, the owners will buy back the shares, and so you've got a buyback, so you've got ROE enhancement, you've got EPS enhancement, and they've also tried to sell down their offshore assets, a huge amount. I think it's in excess of 10 billion Aussie. And you want to buy in Australia, you want to buy an Australian REIT, you don't want to buy a REIT that is in Europe, US, or whatever that is. So because of the lowering of interest rate, because of the buyback, because of the selling of offshore assets, bringing it back domestically, I think the prices have really, really gone up. But going forward, while we like the defensiveness in Australia, I think don't discount the capital appreciation angle. Number one, yields are still above the means. Okay, the yields above the risk-free rate. Number two, you've got to realize that rates are so low, borrowing costs are so low, and REITs are going for a 7-year term bond duration. You can have a cheap funding avenue to grow your M&A angle. And the last one is that because of the narrowing of discount between the share price and NTA, it's okay if you buy assets via equity issue. The dilution effect is very, very minimal. And the amount of M&A domestically by REITs have been very, very small over the last 2 to 3 years. And so there's a organic growth angle to look at in Australia. It's not as if it's all over, And the good thing about our REITs, because it's all over Asia Pacific, where we see a growth angle, we can move to Australia. When we first started, then we saw Singapore with a huge discrepancy in terms of yield. Then we went to Singapore, and then she saw niche markets in Japan, like how she explained, or in Thailand, or in Hong Kong, where there's limited supply, huge asset enhancement, and the economy in China is picking up again. So we move our money there. So it's a very good way to diversify your portfolio and take advantage of where you think that's the best capital appreciation, and at the same time giving you your dividend yield.
Looking at September fact sheet, I have 2 questions. Number 1, the fund has about 30% cash. Can you elaborate on the reasons for holding so much cash? And number 2, the fund is underweight on Japanese REITs. Does this mean that the opportunities there are limited?
Okay, number 1, the high level of cash, because of the huge inflows, got nothing to do with our outlook. In fact, we are very bullish as far as the REITs market is concerned. But that's in September. If you look at October fund fact sheet, we are already 80-something%, or even we're trying to push it up to 90%. So that's not an issue. Okay. For Japan, because Japan is not an easy market to analyze. For the last 10 to 15 years, if anybody's in the Japanese market, you buy a whole strategy, you probably won't perform. You've got to trade. And so we are cautious, but we are comfortable. And we will increase the weightage Japan to close to 10% moving forward. And if opportunity permits, that doesn't limit us to 10%, we can go even higher.